She riding foreign Merlin while I swerve. Pedal to the metal and I'm whipping around the curve. And I'm rolling out this marijuana, you can smell the herb. And I'm getting all this lettuce, I ain't talking iceberg. I've been getting dirty money, Jordan Belfort. Stacking penny stocks while I'm flipping these birds. Sipping on Ciroc, trip 'em up with the words. I done popped the Molly and I think this is my third. Jordan Belfort.
Joe Biden and Kevin McCarthy reached a deal to cap the national debt, even after Biden made it clear that he was not going to stop spending. But before we get started, we're going to go over exactly what I'm wearing today, and this is the first ever sample of the merchandising on this show. So if you guys are interested, I'm going to be having plenty of shirts, sweatshirts, you name it, available in the next couple weeks on an Etsy site. So this is just a sample. Going to have plenty of different things you guys will like, especially New Balance branded items. So that'll be something to look forward to. The full legislative text of Speaker Kevin McCarthy's agreement in principle with President Biden to suspend the nation's borrowing limit, it revealed that new and important details about the deal which lawmakers are expecting to vote on this week. The centerpiece of this agreement remains a 2-year suspension on the debt ceiling, which caps the total amount of money that the government is allowed to borrow. Suspending that cap, which is now set at $31.4 trillion, would allow the government to keep borrowing that money and pay its bills on time. As long as Congress passes the agreement before June 5th, which Treasury has said that the United States will run out of cash, and there's no debate there. In exchange for suspending the limit, Republicans demanded a range of policy concessions from President Biden. Chief among them are limits on the growth of federal discretionary spending over the next 2 years. And Biden also agreed to some new work requirements for certain recipients of food stamps and the Temporary Aid for Needy Families program. Both sides agreed to modest efforts meant to accelerate the permitting of some energy projects. In a surprise move, a fast-track to construction for a natural gas pipeline from West Virginia to Virginia that is now championed by Republican lawmakers and a key centrist Democrat. So temporarily suspending the debt limit, the deal suspends the nation's $31.4 trillion borrowing limit until January 2025. Suspending this limit for a period of time is different than setting it at a fixed level. It essentially gives the Treasury Department the latitude to borrow as much money as it needs to pay the nation's bills during this period of time, as the department employs accounting maneuvers to keep up payments. That's different than the House bill passed by Republicans, which raised the limit by $1.5 trillion, or through March of 2024, whichever came first. Now, you need to understand the consequences of a default on a country's debt. And this isn't just the United States, this is any country. The stability of a nation's economy relies heavily on its ability to honor its financial obligations. One of the gravest risks a country can face is the prospect of defaulting on its national debt. A default occurs when a government fails to schedule payments on its outstanding debt, which the United States has clearly been guilty of, and therefore causing severe repercussions for the economy and its citizens. Defaulting on national debt sends shockwaves through financial markets, leading to increased volatility and uncertainty. Investors lose confidence in the country's ability to repay its debt, resulting in rapid sell-off in government bonds. The sudden surge in bond yields increases borrowing costs for the government, corporations, and individuals. And the stock market often experiences sharp declines as investors flee to safer assets, leading to a decline in overall economic activity. The resulting financial market turmoil can trigger a domino effect, destabilizing the global markets and causing widespread economic distress. And not only that, a default on the national debt tarnishes a country's reputation and credibility on the global stage. It erodes the trust and confidence of foreign investors, diminishing their willingness to invest in the country's economy. The loss of credibility makes it significantly harder for the government to secure future financing at favorable terms. The United States may also find itself excluded from international capital markets like we've seen with oil, limiting its ability to raise funds for critical infrastructure projects and economic development in general. And moreover, defaulting on debt obligations can strain diplomatic relations. A default may also lead to interest rates being driven up, which make it more expensive for the government and its citizens to borrow money, which we see in times like now. Lenders demand higher rates as compensation tends to be higher risk associated with lending into a country that has defaulted. And this increase essentially is borrowing costs affected with not only the government, but also businesses and individuals seeking for loans and investments, and even expansions or personal needs that you might need for a loan. So higher interest rates dampen the economic growth, obviously, discourage investment, and reduce consumer spending. And this leads to slowdown in economic activity and job creation as well. With the default of a national debt, you also have to keep in mind things like a recession or depression, which the economy is just absolutely failing and turning for the worst, which we could very well be in here soon. As the government faces a shortage of funds, it is forced to implement austerity measures such as deep spending cuts and tax increases. These measures contribute to reduced government services, including healthcare, education, infrastructure, and social welfare programs. And additionally, the contraction of the economy leads to job losses, business closures, and a decline in living standards for the population at large. Under the new legislation, the debt limit is going to be set at whichever level it reached when the suspension ends. And Republicans tend to prefer suspending the debt limits rather than raising it, because I think it allows them to say they did not technically greenlight a higher debt limit. And the suspension will kick the next potential fight over the nation's debt load to 2025. Past the next presidential election, caps and cuts spending the bills, but so-called non-defense discretionary, which includes the domestic law enforcement, forest management, scientific research, and more for the 2024 fiscal year. It would limit all discretionary spending to 1% growth in 2025, which is effectively a budget cut because that's projected to be slower than the rate of inflation. Legislative texts and White House officials tell different stories about how big those cuts actually are. The deal reached by President Biden and Speaker Kevin McCarthy would suspend the nation's debt until January of 2025, like I mentioned earlier. And this would allow the government to keep borrowing money so it can pay its bills on time. Spending caps and cuts would also be affected. And in exchange for suspending the debt ceiling, Republicans demand a range of concessions. The deal also claws back $10 billion in IRS funding and food stamps, essentially. The bill would place additional work requirements on older Americans who receive assistance through the Supplemental Nutrition Assistance Program, but also would expand food stamp access for veterans and homeless people and student loans. The legislation would officially end Biden's freeze on student loan repayments by the end of the summer. It would also prevent the president from issuing another last-minute extension, as he has done several times. So both sides agreed to new measures to get energy projects approved more quickly. The deal includes a win for Senator Joe Manchin of West Virginia, a Democrat who strongly supports fossil fuels, by fast-tracking the construction of a continuous pipeline. Democrats included $80 billion to help the IRS hire thousands of more employees and update its antiquated technology in the last year's Inflation Reduction Act. The debt limit agreement would immediately rescind $1.38 billion from the IRS and ultimately repurpose another $20 billion from the $80 billion it received through the Inflation Reduction Act. Administration officials said on Saturday that they had agreed to reprogram $10 billion of this IRS money. Preventing a government shutdown, the agreement only sets parameters for the next 2 years of spending. And Congress must fill them in passing a raft of spending bills later this year, or we will be in for a really big load of trouble. Large fights loom in the details of those bills, raising the possibility that lawmakers will not agree to spending plans in time and the government will shut down. The agreement between Biden and McCarthy attempts to prod Congress to pass all of its spending bills and avoid a shutdown by threatening to reduce spending that is most important to both parties. If lawmakers have not approved by all 12 regular funding bills by the end of the year, so it's pretty obvious here that both parties don't have interest in serving the people. Well, at least the Republicans can see what's going on here. They understand that we need to fix this issue, and the Democrats just want to keep digging deeper and deeper. So, obviously, the Republicans are wrong for crossing deals and making some sort of arrangement that benefits both parties, and it's really one of those things that's it might help one issue, but it's going to hurt 3 others. So is that really helping? I don't think so. Republicans wanted much deeper spending cuts and stricter work requirements. They also wanted to repeal hundreds of billions of dollars in tax incentives signed by Mr. Biden to accelerate the transition to lower emission energy sources that fight climate change. And Biden wanted to raise taxes on corporations and high earners to take new steps to reduce Medicare spending on prescription drugs, and none of which was actually mentioned in the deal. Faulting on a nation's debt are dire and far-reaching. Financial market turmoil, damaged global reputation, increased interest rates, and economic contraction are just a few of the catastrophic outcomes that follow such an event. Now, governments must prioritize fiscal responsibility, prudent economic management, and effective debt management strategies to avoid default. Time they take some accountability, because we just are going to keep bailing them out, and the future generations behind us are going to be the ones that are responsible. Our grandkids are going to be absolutely screwed out the ass with inflation and all sort of policies that are going to leave them with next to nothing. If they actually honored their financial commitments, the United States would actually be able to foster stability, attract investment, and create an environment conducive to sustain economic growth and prosper for all its citizens. But that's not the case, because they've led us to where we're at today, and $34 trillion or whatever it is. We'll have to see how this works out, but at this point it seems like giving a machine gun to a bunch of chimps. we've seen the results, so you can't really expect too much. Tuning in for this episode, had to mention the debt ceiling and that crisis going on, but we're going to have some interesting content ahead. Going to have several guests, two of which who are music artists and one who has experience in the military. So it's going to be really interesting how those conversations play out in the next couple weeks, but stay tuned and we'll have another episode up later this week. It'll be about ESG, New World Order, and the globalist control. So you guys are going to enjoy that one. Other than that, make sure to get yourself a shirt and some merchandise when the link drops next week, and we'll see you next time.